Hi, this is Dr. Charlie Peterson. I'm the author of Dude, Where's My Profit? The way to simply learn and understand accounting. Today we're going to talk about financing a corporation. Now, as you know, there are three general forms of business organization: the sole proprietorship, partnership, and a corporation. So our focus today is on a corporation because it's a very important part of business organization. Now, what I've drawn here, it looks like an amoeba. These are the limits of the corporation. And on the left-hand side, we have debt, and the right-hand side, we have equity, which matches the right-hand side of the balance sheet. So your balance sheet then is assets equals liabilities plus stockholders' equity. So this is the liability over here. This is the stockholders' equity up here. Let's start with the bank. Now the bank lends cash to the business. So cash flows into the business. And the business gives the bank a note payable. So this is the cash going in, and we have a note payable going from the business to the bank. This is the proof that they borrowed the money and how they're going to pay it back. Now I'm going to put the arrow at both ends of this line because this is debt, and debt has to be paid back. Now, businesses also have to pay interest. Now, this is the interest payment. That's the interest payment, and this is the money. This is the money that the bank has to pay in order to rent the cash for a particular period of time. So this is one way that businesses finance their corporations. Now a second way is through bonds. Corporate bonds. You know, we got all this little legal stuff here. A corporate bond can be purchased by individuals or other businesses, and what happens is that the bond holders transfer cash into the business, and the business gives to the bondholders bond certificates. Now I'm going to put the arrow at both ends on this because this is still debt, and the corporation is obligated to pay back the bond at a certain period. And again, in order to rent the money, corporations have to pay the bondholders interest. So let's digress for just a second on bonds. They are in a denomination of $1,000. They have a semi-annual interest rate, which means that they get paid. The bondholder gets paid 2 times a year. Let's assume that the interest rate on these bonds is 6%. Let's also assume that the term of the bond, in other words, how long the bond will be in effect, is equal to 10 years. Now, the interest rate is 6%, so if you take $1,000 and multiply it 0.06, you come up to $60. $60 is the annual interest rate. However, it's paid semi-annually. So that means that the bondholder every 6 months will receive $30. They receive $30 for 10 years, and then at the end of 10 years, if everything's going well with the corporation will pay back the $1,000. Again, this is debt, and has to be paid back. Now, over here under stockholders' equity, stockholders, let's kind of jazz this up, make it look really fancy here. Stockholders can become owners of corporations by buying corporate stock. Each share of stock represents one vote in the corporation and establishes the ownership. So the stockholders transfer cash into the business by the purchase of the stock, and the business gives the stockholders stock certificate as proof of ownership in the corporation. Now you'll notice this arrow right here does not have an arrow at both ends because the company is under no obligation to repurchase your stock, but it does establish your ownership when you receive the stock certificates. Now, on occasion, or maybe more often than that, there's a payment of profits back to the stockholders called dividends. Dividends are decided by the board of directors. The board of directors oversees the corporation, and if they decide there's enough cash in the business to pay a dividend will be paid. So if they declare a dividend of $1 per share, that means if you own 100 shares of stock, you'll receive a check for $100. Again, this is an optional thing. Some companies need the cash to continue to grow, so they do not want to pay a dividend. Other companies generate a lot of cash, and so therefore they'll pay a dividend to the stockholders. Now, the three ways of financing a corporation: we have debt and equity. We have the bank borrowing money, selling shares of bonds, and we have stock equity here. So corporations, now just understand, corporations are the only form of business organization that can sell shares of ownership in themselves, called stock. So the stockholders become owners, and they have all the rights of ownership that precedes the purchase of the stock. Thank you very much for listening. For more information, please go to www.dudewheresmyprofit.com. Thank you.